Well, hello, my faithful students. I'm posting this on April the 2nd. I apologize about the irregular posting of these videos, but we're on asynchronous DSL out here where I live, and for long periods of time you can't send anything out. That was the case yesterday. I wanted to send this out last night, and I wanted to send it out a little after noon, and I wasn't able to. Finally, it cleared up enough for me to try to get this out right now. So we're going to be talking about contangos today. This is a continuation of the series on futures. This is 3 of what will probably be 4 because we need to get back to options and the like after this. Let's raise our standards, as I suggest here, in terms of what it is we want to buy with the profits we make on trading futures contracts. Before, of course, we had the Bentley Bentayga. We've long since passed that standard. And so I'm thinking we should settle upon trying to get a Koenigsegg Gemera electric hybrid, a car that has just been released, isn't yet available, but we have our order in at O'Gara Coach in Beverly Hills. This is an interesting car. It's actually an electric hybrid. It's capable of producing 1,700 brake horsepower. And they claim, the famous engineer who designed this car, claimed that this is able to go from 0 to 60 in 1.9 seconds. It actually blends an electric powertrain with 3 batteries and a famous 3-cylinder, 2-liter engine that is capable itself of putting out 600 brake horsepower. But you could drive this car to work and back at Harvey Mudd, or I could, for example, using just the electrical part, which carries a car for about 60 miles before you have to turn on the little 3-cylinder engine. Or I should say, well, it is little. It's only 2 liters. That a 2-liter engine could put out 600 brake horsepower is pretty impressive. And you can see here the interior is a bit exotic, so I think it would draw a little bit of attention. It would be an emblem of success. So that'll be our standard for this. Let's see if we can talk about contangos or understand them a little better. Now, as I say here, most of the literature, when you see references to contango, especially on places like YouTube or on the internet, refers to any schedule of futures prices that is above the spot price and rising as the maturity extends, as the contracts go farther out, such as the graph on the left, as a contango. And usually I'll use that definition if I'm just talking loosely about a futures contract being in contango. In some literature, a contango is defined as a pricing situation only where the futures price is above the expected spot price, as shown in the bottom graph. So if you have the expected future spot price rising over time, and that would imply, therefore, that what that means is that when that day arrives, you expect the spot price, the market price for that day, to be a certain level. That is the expected future spot price. If the future price is above the expected future spot price, some call that a contango. To keep the distinction, I'll refer to that as a pure contango. So if I use that word, I want to use that concept, we'll call it a pure contango. Now, the latter definition gives rise to the possibility of a rising futures chain that is nonetheless not in contango. So if you can look at that little graph I have on the bottom left, if the red line is below the green line, that would not be considered a pure contango, just a contango or nothing at all. This is actually quite relevant, as we're going to see by an example, because in arbitrage, we are going to consider doing the contango spread. And this lecture is based upon an actual contango spread that was available yesterday. Would have been closed out by today, but you'll nonetheless see what I'm talking about as we get down here. Now, the emphasis here is on contango. The reverse of contango is called backwardation, and that's, of course, when prices are falling, going out to the futures. And a pure backwardation is when the future price would be below the green declining expected future spot price. The only examples we use here are contango, because that's much more common than backwardation. But also, all you have to do is reverse the circumstances, and basically the analysis is the same. So let's take a look at a very famous contango example. And this was the oil spread in late 1928 for the 2009 contracts. And so you can see when we look at the actual display cut out of ino.com, where it says oil in late 2008, that the January contract was at 43.15 and the January 2009 contract was at 43.15. The January 2010 contract was at 58.78. So that is a contango. If you look over to the right and see the performance of the January contract through its entire life, that of course was the crazy wild oil boom that took the price of oil up to $140 a barrel from 60 and then saw it collapse down to 40 in a single futures contract. So even though we have seen something almost as extreme as that recently, we haven't seen anything quite that extreme. And as I that was described as a 6 sigma petroleum, which is going to give you a similar read, and simply calculate the standard deviation over, say, 2 or 3 years, and then all of a sudden you have this explosion in prices, then it's going to look like the move is at 6 times what you estimated earlier to be 1 sigma. And again, that's the sense in which we use those kinds of terms. So this is a contango, clearly. Now, we have to stop before we say much more about the contango and explain why the futures price is not necessarily the same as the expected future spot price. Some people sometimes treat it to be the same, right? You say, well, the price of oil is $38 a year from now, so that's basically what we expect the spot price to be then. That's not necessarily true, and in fact, typically it's not true. So let's take a look at why not. Now, this example is kind of hard to follow, so I'm going to give you a conceptual discussion of it, and then an example, and then a second example. This is something you really do need to understand. First of all, we assume that any market, hedgers are one side net. Say hedgers are net long in a market, and speculators are on the other side, net short. So we say hedgers are either net long or net short, and speculators are the opposite. And for example, if you're talking about the coffee market, you say, well, who's doing the most hedging? Is it Starbucks or is it the coffee growers? For example, if Starbucks is doing the most of it, then Starbucks is hedging on net long, for example, and the speculators would be net short. So we're assuming that it often is unmatched, or typically is unmatched. Speculators as a group are able to estimate the future spot price of a commodity, and they might all agree. So let's assume that that's the case here. Now here what we're saying that they estimate is the actual market price of coffee, say a year from now, or the price of oil a year from now on that day. The spot price is, of course, the current price. And so we're saying you can estimate that. We may say ourselves, for example, that I estimate the price of oil a year from now to be $32 a barrel. And let's say there's a consensus on that. Speculators will go short in a future only if the futures price is above the estimated future spot price of a commodity. Otherwise, for them, it is a zero-sum game with risk. Now, that's the part you really have to understand. So if I think that oil is going to be $32 a barrel, then I'm not going to be shorting any futures contracts at $32 a barrel because by my own estimate, I just break even. I'm only going to short oil if it is at a more attractive price. That's going to be the key to how this works. Secondly, hedgers, therefore, must be willing to pay long at a price above the estimated future spot price, or the market won't clear. So if you're hedging, then you have to be willing to pay an insurance premium if you do this. It may actually be the case that you and the speculators all agree on the expected future spot price of oil. Maybe the speculators say it's going to be 32 bucks. Maybe the hedgers also say it's going to be 32 bucks. You all agree. The trade is not going to carry at 32 bucks though, because it's not profitable in a statistical sense for the speculator. Therefore, when the market clears, the futures price will be different than the expected future spot price. That's the key to understanding this. Now, so when we look at this all at once, and it is assuming here something that wouldn't necessarily be true for the sake of example, the speculators and hedgers all agree on the future spot price, when in fact we know out there's a full range of estimates for that. But that's the key to understanding these examples. Let's take a look now at a couple of examples. Okay, let's use wheat first. Suppose that the spot price of wheat is currently $4.20 per bushel. This is an old example, so I don't know whether that's close to wheat or not. Suppose that both millers and speculators think that the future spot price of wheat in 6 months will be $4.60. Millers being those who buy wheat and have to take delivery in 6 months. Millers would like to lock in the price that is paid for their wheat by going long in the wheat futures market at $4.60, given that that's still an acceptable price for them to pay. But speculators will not agree to go short unless the price is above $4.60. Now, you should, at this point, understand why that's true, right? Why would speculators who believe that the price of wheat in 6 months is going to be $4.60, why would they not be willing to short it at $4.60? Therefore, if the millers want to hedge, they must agree to go long at a price above $4.60, or the market won't clear, even though they estimate the future spot price to be $4.60. Therefore, by example, the market might clear at $4.80. Now, that's going to be a higher cost for the miller, but it's going to be a settled cost for the miller, which is to say they now know what they're going to have to pay in 6 months, and it's $4.80, and they find that acceptable. The speculators trade because their models tell them that they have a profit built in, according to their estimates. They might not be willing to trade for a higher price, like $4.90 or $5. Let me also give you I have these arrows in here to go through this one by one, and I forgot to do that, so let me just click through this. This video slideshow was done almost 2 days ago, and I almost forgot what's in it. Let's get to this. Okay, now let's look at something more contemporary. Let's look at oil, because we're going to use oil here in an example of trading, as an example of trading contangos. Okay, so let's say that the seller short, us, and the buyer long, the hedger for oil, both agree that the spot price in oil in 1 year will be $32, even though it's only $21 now. So you think about this. As sellers, what price would be acceptable for us to make this trade? Now, it has nothing to do with the $21. It has nothing to do with, there's a spread between $21 and $32. It has to do with what we think the price of oil is going to be in 1 year. And if we think it's $32, then if we short at $32 and we're right about the expected future spot price, we won't make any money. If it turns out that it's $30 and we short it, then of course we'll make even less. Now, to use this example, this explains to us all possibilities that arise from hedgers being net long or net short. And this is kind of hard to understand, I think, unless I very carefully explain it. So let's take a look at the upper half that's in the number 1 quadrant that is labeled contango to start with. So let's say that we have the current price, and let's say that we believe the expected future spot price is going to be rising, which is to say that the further out we go, the higher we expect the price to be. Now, an example of that would be oil right now at $21, next month $22, the month after that $25, $27, $30, and so forth going out, which, by the way, is the situation currently in the oil market. We're saying, based upon what we just said a minute ago, if hedgers are net long in this market, which means we're on the short side if we're not hedgers, then this is going to be a pure contango. The red line is a pure contango because that's where the futures price is above the expected future spot price rising. So now you can maybe see why that definition actually matters a little bit. because it's going to be our position in a futures contract not relevant to today's price, either for futures or for spot, but to where we think the expected future price is going to be. That is going to be what determines our trade, and that's why this matters. If hedgers are net short, then we're going to have to be on the long side if that's true, because this will be, I'm still talking about the contango side of this, this will be a contango, the green line, but it is not a pure contango because the futures price is below expected future spot prices. Now, we're not saying much about backwardation in this, but the backwardation is a reverse. In backwardation, you have futures prices going down as you go out in time. And you don't see that very often, but you do see it from time to time. So if you have expected future spot prices falling, then in this case, looking at the bottom red line in the quadrant now, quadrant 4, labeled backwardation, that's where we are. If you look at the bottom red line in this, then if hedgers are net short, then this line is going to be in pure backwardation. It's going to be lower than the expected future spot price. If hedgers are net long in this contract, then it's going to be between the expected price and flat line, or the current price going out, and therefore in backwardation, but not pure backwardation. So those are the 4 possibilities that are considered when you do a futures contract where a contango or backwardation is involved. Now, I know it's complicated, but you have to understand that this is how it works. It is systematic. It's logically very systematic. So kind of dwell on this slide a little bit and think about it a little bit more. Now, let's remind ourselves of something. So you say, well, would this work for like index futures, like SPX? No, this is not relevant to XBS, nor is it relevant to FX futures, nor even is it relevant to oil, unless there's no oil storage capacity, which is the case presently. There's oil storage is largely used up. Natural gas storage is very close to being used up. There is a possibility of storing oil that has been discussed in the media in the last 2 days. That's leasing these large empty tankers or large ships and just filling them with oil and keeping them at anchor. And those who are able to do that are doing that. But that's a very high carry cost for that, and not everyone can do it. So basically we have the no storage situation for even the storable commodities, oil and natural gas, especially oil. And so therefore the FPUL, remember the future price upper limit, and the FPLL, the lower limit, which is determined by arbitrage, does not apply. And so oil is in contango only because this is a rare exception where it does not apply. Now, you know, on index and FX futures, they go out flat, because if they didn't go out flat, then there would be instant arbitrage possibilities that would be taken advantage of by program traders. So this is never going to be a situation for SPX. It's only key commodities that we find this. Now, there's one more thing that you kind of need to understand here. Again, is that we do have a convergence, and the convergence is actually to the spot price on the time of the expiry. And if you're correct about the expected future spot price, it is to that. And this diagram right here is assuming that that's the case. So if hedgers are net long, which implies that speculators are net short, then the further back you are from the day of the expiry, the greater the spread between the expected future spot price and the actual futures contract price. So if you go back to that green line, for example, on the left, then that represents the spread between the futures price and the expected future spot price, let's say a year out. As you get closer, it's going to converge. Even if the expected future spot price bounces around, which of course it's actually going to do in reality, you still get this convergence to whatever that is. If hedgers are net short, once again, the spread between the expected future spot price and the futures price is wider. The further out you go, the closer you get, the more the convergence. Now, you kind of have to keep that in the back of your mind when you're trying to evaluate the values of spreads and the like. And there's only a point to where I can actually show you that in this video. You kind of have to trade them a little bit to understand why this is so important. You begin to see these convergent properties with actual trades, but I'm sort of warning you that they're going to be there so you can expect them. Now, we have real numbers for a real problem. So I put this slide together on March the 31st. This is now April the 2nd. So unfortunately, a little bit of time has passed. So what we're looking at on the left side is my Interactive Brokers trading site for all the contracts that I trade from time to time. So you recognize natural gas, and down there on the bottom you recognize oil. And I'm currently in an oil trade, and if you look very carefully up there at this account window, on that day I was down $3,865 on a short trade. And I'll explain that in just a minute. And so if you also look at the graphs in the middle, then the QM May 20 is the E-mini contract on crude oil that, as you can see, was bouncing around quite a bit. And that's the May contract. And the one just below it is the June contract. And I was currently long in the May contract, and that's why the account was down quite a bit. Now, that's largely been recovered. Most of the recovery was today. I'm only down about $600 on that contract as of today, but let's not jump ahead on this. So, okay, let's blow up a segment of that. Is any of this that I've just looked at or shown you here in contango? And the answer is that contangos are rare in oil because usually there's adequate storage, but we are definitely having a contango now. And this is what we were looking at on March the 31st. Which I guess was what, a Monday, right? Yeah, it was Monday. Okay, so look at this under the March 31st financial instrument category. So we have the May 20, the June 20, the July 20, and August and September 20, all of the big contracts is what I'm showing you. Now, although the market was open at this time, let's look at bid to get a better comparison of the spread. Now, that's a contango if there ever was one, right? We got the May at $20. The June at 24, the July at 27, the August at 29, and the September at 30. Now, again, you don't normally see this in a normal year because normally there's storage, and so the upper limit is more effective. Look down at the spread that I have where it says, what kind of contango is this? And so, again, we have the same prices, but I have the spread also. An almost $4 spread on the May-June, a 310 spread on the July-June, 207 August-July, and September 20th at 3080 has a 132 relative to August. So those are huge spreads. The one we're mostly interested in is either the May-June, which is the one I'm more or less playing, and the one between June and July, or maybe between, say, June and September. Now, where it says carry at 10% annual, look on that spread there and find that column, carry at 10% annual. That is keying off the $20.38 price because we're calculating what the future price upper limit would be for that contract if the carry cost is 10%. And we can see that these prices are way past 10% carry. In other words, you read that June 20 carry at $20.55, that's the carry cost of doing arbitrage between the June and May contract if you have storage, and the storage is only costing you 10% annually. You can see, therefore, that the carry even for the September 20 contract at a 10% carry is only $21.07, and yet the price of oil is $30.80. So this market is not functioning for arbitrage as it normally does. However, that means it is presenting to us tremendous spread opportunities that we might decide to play. Now, here's another question, therefore. Look at the list of questions where it says, what kind of contango is this? The first question is this beyond any reasonable carry cost? And the answer is yeah. I mean, if the carry cost was even 30 or 40%, the September 20th would be outside of it, therefore above the arbitrage limit. And therefore, it's not being arbitraged the way it normally would be because there's no place to store the oil if you have to go long to deliver short later. And so when storage dries up, this happens in oil. It doesn't happen very often. So here's a couple of questions. Should we play this? And the answer is going to be yes, of course. Should we go long in May and short June, for example? That's a $3.93 spread, and that's going to be the one we consider here theoretically. Or should we go long in May and maybe short September? Now, these are hard decisions to make because you have to remember that the May contract has an expiry, and the expiry is in the third week of April, and that's only 3 weeks from now. This is now April 2nd. When I made this up, it was a couple more days past that. So therefore, whatever we think is going to happen to give us profit has to happen in the next 3 weeks. If we don't think that's very likely, we're going to have to be either May, September. Well, actually, we wouldn't be May, September if we think that's the problem. We would have to be June, July, or June, August, or June, September. If we're saying, well, whatever's going to happen is going to happen, but it's not going to happen in 3 weeks, we can't use the May contract. And you'll see why here in just a minute. So is there anything else that we want to ask? Well, here again is our position. Should I, given that I'm already short in the May contract and down almost $4,000, should I short June or September to turn this into a spread, for example? And we'll talk a little bit about what I decided to do about that, because I had to do this yesterday, trying to post this video up, and I was never able to get it up. I run, of course, the interactive brokers in my office upstairs, and it fortunately does not require a lot of bandwidth going out. I'm only getting like 2 kilobytes going out, and so something like 10 megabytes coming in, but only 2 kilobytes going out. So there's almost nothing going out. But of course, you don't have to send much out when you're doing trading signals. But doing a video like this, it's really a problem. Okay, so let's talk about the model that would allow us to consider this. And so let's work through this systematically as we always do. So we say, okay, if we did a model, and I'm not doing it with a model right now, I could and probably will do one when I get a chance, because it doesn't take much to convert from our options model, this kind of model. Perhaps a mean reversion model would work, because we get this cyclical behavior in futures that I haven't shown you, but it has been very cyclical. Possibly a Bollinger Band model, which is simpler than the ones we talked about. We'll talk about Avi Thacker's models. Any technical model, because YouTube is full of technical models right now talking about these markets, but also a statistical arbitrage model, which is a little more consistent with what we've done so far. So let's talk about how we would set that up if we were to do it. First, we would convert all data for the prices in consideration in the past to a log spread. For example, the natural log of June over May. It's going to be a fairly short sample, of course, but there's going to be about 30 days or so. Or we can do this for multiple contracts going back, but as I'm going to say here in just a minute, we have to adjust for the fact that there's rollover. So anyway, if we did the natural log of June over May and then adjusted it for time, then of course we have once again a log growth spread. Figure out a way to smooth for the rolls, and that's kind of hard to do, but there are ways to do it as the contracts expire. Because especially if you're in contango or something, the rolls could get a little bit awkward when they come. And by that I mean, if you have to roll out of April into a May, if they're not at the same price, then of course you're going to lose a little bit if the May price is above. You'll gain a little bit if the May price is below. And so if that's in your data, you have to smooth that out because it'll cause problems. It causes problems for future ETPs like USO. We either regress, test, or use our simpler methods to calculate mean spreads and standard deviations of all of this. So basically, we're taking a look at the spreads historically between various months. Now, even if there's a future price upper limit and lower limit, there will be spreads because the future price upper limit is pretty quickly rising for high carry cost contracts like oil. The carry cost for oil is not cheap like it is for an index fund. So you'll still get any kind of possible movement in spreads between those. You can have a futures contract for oil in contango, just not a pure contango, because it can be bumping up against the future price upper limit, for example. So there will be a spread between each month in that series if that's true. And this is what we're saying we calculate. Run a sigma algo with a daemon about every 15 seconds to check against current sigma estimates to see if anything is becoming anomalous. Make sure another algo is keeping current sigma up to date. Now, when we get back to talking about options here, of course, I've been keeping records of all these options trades and so forth, except for the few days that I was home and all the stuff was at mud, so that big gap in the data set for that. But of course, we're tracking implied volatility and historical volatility for both SPY and a bunch of other stocks like AMD and gold and a few of the other indexes. And of course, it gets a little controversial as to what you use for a historical volatility estimator if all of a sudden the market gets crazy like it is now. And when we get back to options, we'll review those again and say, well, what do you use for historical volatility when it's been flat for a year and then just starts ramping up? Also, when you're estimating 30-day volatility, when it's ramping up, of course, the first few days you're only capturing 2 of the 30. Toward the end, you're capturing 30 of the 30. And so, of course, the rise in the 30-day volatility historical estimator becomes kind of exponential there for a short time. So if you're doing these kinds of comparisons and you're trying to compare average to implied, which is what we're doing all the time in options, then you have to put a lot of thought into what you regard as appropriate average. This may not be quite understandable to you yet because we have to go back to options and talk about those historical estimates, and we haven't done that very much yet. I've mentioned it in class a number of times, even before we had to go remote, because it ended up being topical a number of times, but I'm not sure that you all understand what the issue is. So we'll come back to this, but if you ever go back and look at this again, this is actually a very big deal. Okay, then when we spot, say, a 2 sigma or greater anomaly, we consider a spread trade, which in this example would be long May and short June. So in other words, if the spread widens up, then what you want to do is go short on the nearer term contract, doesn't have to be the next one, and short on a longer contract, and that's actually called a calendar spread. But this again is a type of statistical arbitrage model. But we always have to ask, as we did in this situation, when these anomalies show up, and there are rather a substantial number of them, has there been a change of state? Now, I've really been emphasizing that in this class. The models work within a certain state in which they're assumed to be functional. If there's a change in state, the models aren't worth a damn, and a black swan is a change of state, always. As a footnote here, this is one of the reasons why I'm not currently trading options. I don't have a model that really can tell me what to do in this kind of world, because my models aren't calibrated for implied volatility, for SPY being, say, 7 times higher than it normally is. It is actually the case, too, that if you pull down recent data and you try to fit it to a normal curve, it won't fit. It's not normal right now. So how smart is it to use a Gaussian model in a non-Gaussian environment? It'll reemerge. The pieces of the Gaussian structure with the fat tails of course, it's all fat tails right now, essentially is what I'm saying. There's nothing left in the center, literally nothing left in the center. So you can't use a model that's designed assuming that stability in the center for trading anything. And that's why the only trades I'm doing right now are just discretionary judgment trades that are not model assisted. So that's our situation. I'm not going to hold you accountable for this. I hope some of you or most of you understand it, because this is how you would do this. This is how you would set up a class of futures trading that looks for anomalies using statistical arbitrage. And what I kind of mean by that is when I talked about pure arbitrage, that tends to mean that you're guaranteed to make a profit if you do the arbitrage. And that's what high-speed traders are working on. They're working on pure arbitrage models. If I actually get that trade before anybody else, I will definitely make a profit, sort of thing. Statistical arbitrage is much more common, where you're using a statistical technique of some time where the estimated value of the gamble is positive for you. And that's this example, and that's 99% of all examples that don't involve high speed trading. So that's what we're looking at. So let's do this then. Let's actually talk about a real trade. Now, it breaks my heart that because of the problems I'm having here with the internet and my efforts to try to get around that, that I haven't been able to pull off these trades. And I'll show you in just a minute that the opportunity probably has already passed, because this morning the spreads collapsed for reasons I'll explain here in just a minute. So this, though, I put together on March the 31st, right? This is when the spreads were ready to go. So first of all, any model of any kind, I'm not estimating the log value of the spreads here, but I can tell, what a big spread is. These spreads are enormous we're looking at, especially between the May and the June and the July. And it's even respectable between July and August. And of course, the spread between May and September is absolutely enormous. It's a 50% spread. But then on the other hand, we have to be out of the May in 3 weeks, and the September goes for a few more months. But nonetheless, it's still a very wide spread. And again, we remind ourselves that these aren't made up examples. This was the condition on March 31st, 2020. Okay, so we ask ourselves, let's do a spread. Let's do let's see, which spread did I decide to do? I think it was 24. Yep, we're doing the May-June spread. Okay, so the best way to think through this is to think of all the scenarios where you would lose or make money. At least we're going to do that here. When you trading spreads, you kind of get to the point where you understand how this works, and you can model it fairly easy. What if we say, so here's why we asked this question earlier. Are these good estimators for the expected future spot price? And we say, what do you mean by that? I said, well, the June 20 futures is 24.31. Is that a good estimator for the expected future spot price? Because even though we said, if you have hedgers long and short, if they're not imbalanced, then the resulting price is in fact a good proxy for the expected future spot price. And that may be the case here. So we look at the June 20th, 24.31, the July 20th, 27.41. We're saying, actually, is there any reason to believe that that could actually happen, that spot would go to that? Given the circumstances under which these oil prices have fallen, the answer is probably no, because part of the problem is that there's this tremendous glut of production relative to supply now being even exacerbated by the fact everybody's staying home and there's no gasoline supply. But this was triggered off not by that. This was triggered off by a dispute between Prince bin Salman of Saudi Arabia and Putin's oil minister in Russia, where they kind of got, I explained this in a previous video, where they kind of got angry at each other at an OPEC Plus meeting, and the Saudis expect the Russians to go along with a production cut. The Russians said, we're not going to cut our production, and so the Prince bin Salman instructed his own oil minister to actually increase production and slice the price of oil by, I think it was something like $6 a barrel, and down comes the prices of oil. Now, the reason I went long in my contract, although I did it prematurely, was in the belief that that is so unreasonable and will do such damage to both the Saudi economy and the Russian economy that they'll come to an agreement and stop the nonsense and agree to collectively cut production to pull the price of oil back up. So that's why I'm long in the May contract. I was long in the April contract as well, and I rolled out of that with a $600 profit into the May contract. But as you saw just a moment ago, yesterday I was down $3,400 in the May contract. Okay, that's the background. So we're saying, what if it is a good proxy for expected future spot price, which implies neutral hedging, right? There could be hedging, there could be a lot of it, but there's as much hedging on the short side as the long side. So the hedging effect is neutral, and that may actually be the case in oil. Okay, if that's true, then the 24.31 short would stay steady going out to its own value. So we're saying, well, we think that 24.21 is, or 31 is actually a good price for June. And that would be the actual third week in May. And so, because remember, the contracts expire at the end of the month before. So 21.31 would stay more or less short. And because they have to converge, that is to say, they have to converge toward the expected spot price. Let me go back now and explain the relevance of this slide here. Oops, sorry, going the wrong direction. Should have put this, oh, I better not do this, right? I forgot I had all this stuff in there. This is just, I should have thought about this, sorry. There, this one, okay. That's what we're representing here. Again, they both have to be sort of going toward where the tendency is, even if it's far off in the future, and that's what is being represented in that diagram. Now I have to jump way back through all those animated slides, including this one right here. Okay, back to here. So we're saying that the short, of course, is going to go to its expiry, because we're saying it's going to be at the spot at its expiry. This means that 2038 has to be going in that direction too, but it expires. So what we will see for it is this price pattern represented by the solid green line is following theoretically a tendency of the dotted green line. Now, if we are short on the top and long on the bottom, do we make money? And the answer is yes, because the spread is narrowing here, and it's narrowing by quite a bit. And so this would actually be quite profitable if we conclude that these prices are good proxies for expected future spot prices. So right there, if that's what you think, if that's what you're looking at, then you have every reason in the world to do a spread like this. What if, on the other hand, it's not, but what if they converge to a spot in between? You say, that's a big spread, $3.93 for 1 month. Really, is oil going to go up by that much? Now we know it can. It can go up by that much in 1 day. Now it's so volatile. But suppose we say, I honestly think that it's going to go to some point in between. Then what will happen is the short will come down as shown, and it will go all the way to the end. And the long will go up as shown in the convergence as before. Remember, they're both trying to converge to the adjusted expected future spot price. And of course, again, we roll out of the long in the solid green line at the end of that. And that probably implies that we have to roll out of the short at the same time, because we don't want it to turn into a one-legged option. We may decide to roll into the next contract or something like that, but let's just say we exit, okay? Now, when the 24.31 is going down, the blue line going down, remember that's a gain. That's not a loss because we're short. So this would be an enormous gain. This would really be good because now we have a substantial narrowing of the spread. And you should be able to see that if the spread narrows and you're short on the top and long on the bottom, you're going to make money no matter why it narrows. It can go up and narrow, go down and narrow, go sideways and narrow. If it narrows, you're good, right? And given the size of this, that may be why we're in it. Now, what if the spread increases, though, before the May 3rd expiry, like the third week in April? Then, of course, we lose money because anything that would increase the spread is going to be less profitable in this kind of trade. But if storage becomes available, this spread would decrease, not increase, right? Because if storage becomes available, then these contracts have to start going back toward the carry limits if storage becomes available. And obviously that's true. I mean, if you look at the newspaper and see why is the price of oil plummeting? Because they're producing it and there's no place to store it. And so, of course, down it all comes, in some cases with wide spreads. If all of a sudden, for whatever reason, storage became available, at least relative to production or demand, then that phenomenon is going to stop because you can store it at that point and there won't be such price pressure. That would probably also decrease the spread as well. So that's the sort of phenomenon you want. Now, this means, though, another thing, that when you time your trade, You've got to try to get the widest possible spread to start the trade that you possibly can. You can't just look at it and jump into it. I happened to catch it at a time when I did this lecture where it was at more or less max spread at $4. It has been between $2 and $4 back and forth, including today. It's back down to $2 over the last few days. If you go in at $2 just because you see the spread and you don't think about it and don't look at recent values for the spread, which is why you're using demons, right, to capture the data, to show you the spreads, to calculate the spreads, say, look at this, then you go in at the right time. Because even if you're right in your theory and you just get your timing off during the day and you pop in when the spread is only 250, when it has been as wide as 4, even though you're right about your theory, that spread will go back to where it's been in sort of a, once again, kind of a mean arbitrage type behavior, and you'll still lose money. So you actually have to try to jump into this at the time the spread is clearly at a wide point. Now, so the two people are, what if we were in the June long and September short, and Bin Salman Alexander Novak, who's the Russian oil minister, reach a deal before the third week in May? In this case, they would both rise, or the expected future spot price would rise, as is shown here. But nonetheless, it's probably going to be the case that the spread will narrow. And still, if this happens, which is the reason, by the way, I'm in the contract because I expect this to happen, then we're still going to make money on this, right? Now, remember at the top, when we see the blue line going up, that's actually a loss that we're looking at there. But if the meeting that they have pumps it up, the gain from the 2131 long is always going to be larger than the loss on the 3080 short, no matter where this absolute final endpoint gain goes, even if they agree. So this is also going to be a situation where we would benefit from the spread if we got into the spread properly. Now, I tried to do this spread on March the 31st. The spread appeared at $4 literally in the last minute and a half or so of trade. It was running about 250, and all of a sudden the prices jumped, and there was that $4 spread. So I saw it. I don't have my algos at home able to trade futures. They can trade options, but not futures. So I had to try to do a manual trade, and I did not get the information in to the limit order prices I needed to execute both legs on time. I almost made it, but I didn't make it. That was actually after the stock market was closed. The futures market was still open, but remember there's this gap when the futures market closes for half an hour. It was in that last minute before that gap. These futures markets, by the way, sometimes really jump around in the minute before that final short gap close. So I wasn't able to get in. And then yesterday I tried to get back in again, and I lost my internet connection altogether. So it just seems to be that I'm cursed, because I made this up on the 31st. So anyway, it was a possibility. And before we get to what actually happened, which is going to amuse you to no end, they say, well, let's also look at index futures. So I added this yesterday. And index futures, you say, well, wow, if you didn't know about the arbitrage effect, then wouldn't you say, or wouldn't somebody who doesn't know about it say, what do you think futures are doing for stocks right now? And they say, if you're a bull, you say, well, they're really down, so futures are probably showing it coming back up. And the bear would say, oh, no, we've just, there's going to be more bad pandemic news where the market's going to keep going down. And so therefore the futures are going to go down. Neither of those is correct. Futures go out flat, and look how flat they are. There's a little bit of variance here. You can see we're looking at the MES, which is the E-mini micro, SPX on the top, those three, 2447, 2442. And 2427, that's within the domain, because that goes clear out to December. That's within the domain of the limits. And that was on a day when the Dow plunged 973 points. And by the way, you sometimes see these go outside the limits. That one right there for the December may be a little bit outside the limit. And this sometimes happens at a time when the stock market is closed, but the futures market is still open. That's why, that's when the high-speed traders and whatever are just doing their best to cover the gap, you know. So this was actually, I think at that time, 3:47 p.m. New York time. So let's see, the market was still open. The market closes at 4 New York time, so it was still open. Anyway, it's still pretty flat. And so 2 questions for you. Why is that so flat? To remember that, you have to go back to the arbitrage issue about the future upper limit, future price upper limit, and future price lower limit, and why that can't happen in index futures. And are these futures good estimators for future spot SPX? No, just pointed out. They're terrible estimators. They can't estimate the future because of their own limitations. Now, suppose we had managed to get into that spread, right? Suppose we had managed to have a little good luck. Suppose we had good internet connection. Suppose my timing was better. Suppose I hadn't been so lazy in converting my models over to futures. How would we have done? Oh, we would have really done well, because this happened today. The spread widened to more than $4 for about 10 minutes. And so this happened. Yeah, the spread widened to more than, oh no, let's see. Oh, that's right, today. Let's see, which happened here? Oh no, this is when I tried to get into the trade. Sorry, this is not what happened today. I forgot I had this slide in here. This is where I tried to get into the spread when I told you I ran out of time at 4:15 New York time, but could not use my trading algos. This is for the day before when I was trying to get into that $3.83 spread, because you see what happened right there? These were taken at almost exactly the same time, and the candlestick that I'm pointing to with the yellow arrow is the 2 candlestick. We're looking at the May on the left and the June on the right. And this is not what happened today. This is when I tried to get in. And this often happens, as I just said a moment ago, at around 4:15 before. One of these options prices just goes crazy and the other one doesn't. And see, as you can see here, that one candlestick is down there to about 2050, and the equivalent candlestick, which is on the yellow on the right, is at 24.50. So that's right there. In fact, we're looking, I think, at about a $4.10 spread or so. That's when an algo would have triggered off a trade. Or even I manually tried to trigger off a trade, except that I just wasn't too good at it. You say, that's a 30-minute candle. Yeah, it's a 30-minute candle, but all of that movement came in about 1 minute at the very end. So it was just sort of like the other candles around it before that. All of a sudden, down it goes. Oh my God, the spread is opening up. Let's try to get into this and trade. So it won't just be theoretical. So I didn't and couldn't. But the following day, the spread was still running at about 350. It was still a pretty good spread. But then today, when I was literally not at my desk, I was down here in my studio trying to figure out how to fix this small router. What happens here is I've got the big router upstairs and I got all the satellite routers. All the satellite routers shut down when the internet is off. I have to go reset every single one of them. So I was down here resetting this one so I could get this damn video out. And this happened while I was down here. Trump announced that he was working with Putin and bin Salman to reach an agreement on oil. And it kind of sounded when he said it like he had succeeded. And so this spike is what happened. The spreads narrowed down. To $2.50 from $4. And also, of course, this actually gave me all my money back on my sole long option. Right now, I'm down about $1,200 or so. I was down $3,700. This is what I said would happen. And this wasn't even the result, because it found out later that, typical Trump fashion, he was exaggerating how effective all of this was. Putin apparently is talking to bin Salman, or they're doing through diplomats, and very possibly they will reach a deal. And when they do, then this will go up and it'll stay up. But our spread disappeared, and that's what we wanted. The scenario we described as the very first one in these examples, going back again to, I don't give you a headache, but going back again, which was, maybe I should stop using these animated slides, because this is, maybe it would help if I went the right way. Jeez. Need to put a little more, this one, no, not this one. No, that's, or is this, yeah, this is it, right? The last one, right? Yeah. Okay, this is kind of what happened right here. And as you can see, that does narrow the spread, and it did, from 383 or whatever we would have got it at, around 4, to about 225 to 250. The spread today was running around 225 to 250. So today we wouldn't want to jump into it because it's too narrow. But boy, had we moved on this when we saw it, then this would have been a profitable trade. I, of course, was spending more time explaining it to you or fitting out a slideshow to explain it to you than I was actually doing it, which is too bad. Now, okay, so the trade happened. I want to say one final thing, too. You may remember in Econ 104 that I warned you that ETPs, not ETFs, ETPs, exchange-traded products that are secured with futures contracts like USO, really have serious problems in contango environments because they have the roll risk. They have to roll from a price that expires at 28 into, it's still a spread, right? In other words, into a price at 31, then at 31 into 35. And every time they do, of course, they lose a lot of money on settlement. That is such a problem that when you take a look at VXX ETN, which everybody on Reddit seems to be trading, everybody's talking about the VXX. That ETF, ETN, it's an exchange-traded note because it uses swaps. It's an absolute piece of crap, right? This is its price history going up to 2014. Basically, it, of course, never was at $7,000, but they've had so many reverse stock splits that the way you adjust the price is to adjust it up. If they go from $100 to 10 because they do a 1 to 10 reverse stock split, then when they're at 10, then when it was at 100, it shows the price as being at 1,000, right? So look at the history of this ETN. The reason I don't have it past 2014 is because a couple of years ago, Finance Yahoo, which would have the good free prices between adjusted close and close, they stopped putting in the spread between those two, and so you can't now go to VXX on Finance Yahoo and get the difference between adjusted close and close like it used to be able to do. So I can't map it anymore. But this was the mapping before they did that. Now, why? Years ago, in 2014, in fact, I went and I mapped out the history of every VIX futures contract going back for 5 years. And I have a graph like this for every one of those months, okay? And so every single one of them looks like this VIX futures contract, strange behavior on the left. The blue represents VIX spot. The red represents the futures contract. And these were always in contango. For 4 straight years, they were in contango every single month. And so, of course, because you have the roll risk, then that implies that any ETF's NAV, which is based upon the value of settlement, is just going to go down, 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 down. And that's effectively what VXX does. VXX, of course, can go up a little bit or a little bit down each day based upon what the VIX does, but it just has this huge negative bias pulling it down, which is why it's never suitable for trade. Okay, that was a lot, but on the other hand, this is substance, right? I'm talking about real trades here, and that's what you took this class to learn about. Now, here's some takeaways you need to understand. I'm not going to require you to know all of this. I'm not going to require you to know how you would set up the model because I don't have a model to show you. It's just I described the techniques you would go through. You should understand that, but I'm not going to examine you about it. So here are the takeaways that you must understand. Which you want to try to retain from this lecture. There's an important difference between what the industry calls a contango and what we're calling a pure contango. You need to know the difference between the two. You saw how it mattered when we were considering doing a spread in oil. The first question we had to ask, is that a good estimator for the expected future spot price? Because if it is guaranteed to be profitable, right? 2, understand why futures prices are not good proxies for expected future spot price. There's 2 reasons, of course, because of arbitrage. Low carry contracts like the indexes and FX are always more or less flat, so they never qualify. Even for storable commodities, net hedgers must find speculators to take their bets. Insurers the same, right? If there's net hedge long or net hedge short in any market, it's not logically possible for the futures price to be a good proxy for the expected future spot price. That you need to remember. Whether futures prices are above or below expected future spot prices depends upon which side is net hedging, whether in contango or backwardation. And that's that sort of peacock slide I had. I'll probably ask you a question about that. It's important that you understand that, right? Futures are complex to think about. They're the easiest things in the world to trade. They're a lot easier to trade than stocks because there's no downside to being short in futures. It's just as easy to short a futures contract as it is to go long. That's not true of stocks. You have to be qualified to do the short. You have to have a margin account to do the short. The short has to be available, and you have to pay interest on the short for a stock. You don't have to do that in futures. Futures are better than options because there's no premium to worry about. You don't have time decay with a future. It's just basically, did you get your bet right or not? But on the other hand, the theory behind it, that's where it gets complex. 4, futures must converge to spot, and that convergence will be automatic, right? They have to go to spot. A standard Gaussian statistical arbitrage model can be used to trade spreads that emerge from contango or backwardation, but these are dangerous if there's a change of state. Now, we knew there was a change of state for oil. We understood what it was. It was the combination of declining demand, the fact that the markets are just skewing anyway, and the fact that OPEC, or specifically Saudi Arabia and Russia, are in this giant pissing match with each other. That's why we understood that, but we realized, given that the spreads that we saw there for a couple of days were exorbitant and should be narrowed. And it turned out we were actually right about that. And finally, spread trading logic involves mostly considering multiple scenarios. So you got to think through what has to happen and can happen before you go into a trade like that. So those are the takeaways. Again, I'm not going to ask you about the way you would set up the Gaussian model because I didn't show it to you. I think most of you can figure out what I mean by that, but maybe not all of you can. But the more elementary stuff in this slide set is something that I want you to know. This probably turned out to be, I wish I had had this out though before today, because then we could have come back and I said, see, I told you so. Because for all you know, I actually didn't make any of this up until this morning. And I based it upon old slides. And I said, oh, they'll think that I'm really a genius if I show them that spread narrowed with that news event, right? But I didn't do that. But it would have been, I think, more powerful had you noticed today that spread had narrowed. Then it's all history now. Of course, the spreads may widen back up again. So let's keep an eye on it. Anyway, that's it. I've got one more short, not quite so dramatic slide set on hedging with futures, and then we move back to options and modeling in that domain. Meanwhile, I am piecing together the material I'm going to hand out to you. I'm about done with that also. Good to see you all again, although I didn't see you, but I know you're out there just happy as can be. Probably not. And we'll see you soon. Pay attention to my Sunday night updates. You can watch them later in the week because this is a really interesting market and you should be doing everything you can to learn from this market and put that in permanent long-term SSD level memory, not the level 3 cache. It's got to stay up in your head for the next 30 years.